This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. And also, please feel free to subscribe to our newsletter on Substack, microcapnewsletter.substack.com, so that you can be notified of all new podcasts, new Q&As, a whole bunch of stuff, Vegas, the whole bit. So you can find us on Substack as well. Speaking of Vegas, the Planet MicroCap Showcase Vegas is happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino. We have announced our first keynote and speaker. Andrew Walker, host of the Yet Another Value podcast, will be back to host a keynote Q&A with legendary small microcap investor, Bob Rabati. Our event brings together the best investors and thought leaders in microcap, quality microcap investing opportunities, and above all else, the most fun and highest return on your time that you could ask for. There's more announcements to come, but registration is open. So if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is Josh Young, founder and portfolio manager at Bison Interests. We last chatted on the podcast back in July 2023, so I figured it was time for our semi-annual conversation on energy markets. It was a rough second half of 2023 for oil and gas. Josh provides his post-mortem on what happened, plus how 2024 is setting up when considering all the macro news on the horizon, geopolitical events currently happening, elections later this year, but all things considered, why Josh thinks there is a decent chance that oil could do well this year. Thank you again for tuning in to the Planet MicroCap Podcast, and please enjoy my interview with Josh Young. Josh, always a pleasure, man. How you doing?
I'm great. How are you?
Oh, just telling you a little bit offline. It's grind season, dude. Last time we had you on was July 2023. That was the last time we did the interview. We talked about a bunch of things. I mean, obviously, everything having to do with oil and gas. And if anybody saw my tweet, we're not talking biotech or tech today. But at that time we said, oil and gas was off the radar. So I just kind of want to reflect on 2023 first before we kind of get into some of the other stuff. Can you give your post-mortem on 2023 and we'll go from there.
Well, most importantly, we were talking about books offline. I said, hey, don't turn on the recording. So, I was talking about a marketing book I had read recently, written by a family friend. You were telling me about a couple of books written by Morgan Housel, who I used to work with way back when, and who I actually went to Omaha with, which is happening right around your conference. So, there's a lot to chat about.
This is true. I was telling you that I'd picked up Material World by Ed Conway, and I'm so pumped to read it. I mean, it's on the list. I'm getting into reading again. I'm finally figuring out.
I went to the beach for a few days last week, and actually I was reading this marketing book and then reading Howard Marks's Mastering the Market Cycle, which is fascinating.
Heck yeah. Oh, that's awesome. Yeah. No, I think we should, maybe that'll be our next interview later this year, is our collective reading list and what we thought was good, what was maybe a skip it, or maybe what was a skim. I'm starting to realize that quite a few, especially on the financial books, and that's not any of the books that either I've mentioned or will read, but some of them are, you can kind of just skim, it's all right. But then, especially with Material World, that one I'm super fascinated by. Having covered commodities forever, but there's a few in there that I just love the deep dive. Anyways, back to my question.
Yep. What I found is as I've become more of, I guess, a content creator, it used to be really hard. It's still hard to write Bison monthly and quarterly letters and stuff, and white papers. But I put a lot out now on Twitter and in these sorts of interviews. And actually, I think you did one of the first interviews I ever did like this. I think it was you, and then I was on an oil company's. They do oil field chemicals. I was on their podcast. I can't remember which came first, but it's funny just sort of how these things go. But I'm actually.
I was gonna say, I hope they don't blend into one, at a certain point. I mean, look, at the end of the day, like, I think you're getting on the point about content creation at the end, like, it's just really important to be caught up on everything that's going on. I mean, people can probably hear, where our pod has kind of evolved from is, we used to kind of feature new PMs and new fund managers, and now we've kind of more evolved into just like really covering latest headlines, themes, sectors, and getting folks who are experts in the field to get their perspective on that. And that I think is kind of been a natural progression. I mean, look, small microcaps, it's a pretty small community, right? Like there's only so many PMs and buy side that actually have a micro strategy anymore. It's more or less micro at this point. So that's kind of how we've been thinking about things here.
Yeah, for sure. Oh, right. So what I was trying to say was, I've noticed that actually I care more about the details and the writing style of some of these books. And it's fascinating because sometimes you like open up a book that you sort of skim through, like you were talking about trying to pick up investment concepts, and there's so much there. Sometimes it's the opposite. You go to read it and it's like there's nothing there. But it's been pretty interesting to go back through some of the classics and just sort of see, or like I have Twilight in the Desert up on the bookshelf. I go through that every once in a while and think about Arjun Murthy was at Goldman, and now I think Veritan, famous energy expert. He posted something recently about Saudi's oil production, how they basically had almost never produced more than 10 million barrels a day. And this was something that actually, was in Twilight in the Desert. It was in Bison's white papers on OPEC plus spare capacity. And it's just so helpful to sort of see that and then go back through and see how it was originally sort of framed in Twilight in the Desert. And sometimes these concepts or observations of sort of physical limitations or other sorts of things like that, or aspects of psychology, like some of the stuff in Morgan Housel's book, the first book, really just, they're timeless. And sometimes you don't even really notice it the first time you go through it, but then you go back through and see it again. And it's just, there's sometimes a lot more insight that's buried in some of these things.
Oh, 100%. On my list right now, I have a few rereads of some, like, I read One Up on Wall Street. Like, that was my first ever book in finance that I read, and I haven't read it since. And like, now having done this podcast for however almost 10 years and being in micro, like I need to, I've been like been like staring at me of just like reread me, like it'll be a totally interesting, cool, different perspective now. So yeah, no, I'm with you, man. Listen, I always loved reading, but like, especially when, you have 2 kids now too, man. Like, once you have the kids and stuff and you're like trying to figure out like priorities and, all that kind of stuff, finally this year was just like, all right, I miss it so much. Like, I need to like dive deep again and try to keep, mix it up. I don't just got finance books. I got a couple novels and stuff, and it's a couple biographies. Whatever. Just trying.
You got to get Peter Lynch on. He owns some small and microcap oil and gas stocks. You hear about this from various executives, and maybe he'll come chat with you.
Oh yeah, I just talked to somebody who was at, I guess, the ICR conference, and they saw him walking around there, and so like, that's just a trip, right? Like, he's still in it, man. He's still retired, right?
Yeah, but it's crazy because if you look at what he owns, and then there's been a little bit of media, it wasn't all positive about Buffett's personal account, but you look at what Buffett has owned in his PA and what he's talked about. None of these folks are going and buying like mega caps with their personal money. It's always funny. Like, you see people like with their personal money. Oh yeah, I own IBM or Microsoft or whatever. It's like, what are you doing? Like, that's not the path to be able to compound money above market returns. The path is to go down cap to small and micro cap, where there's really just way less information, way less understanding, and way more potential for better returns.
Literally, that's what, like page 15 from Chris Mayer's 100 Baggers, right? Like it's on my list of rereads right now, like that's it. You said it better than I could even try and articulate myself. So yeah, everybody should come to Planet MicroCap. No, I'm just kidding. But all right. Task at hand. We're talking O&G, we're talking energy, talking resources. I think that, it's good to do this at the beginning of the year to kind of, assess a little bit what happened last year. We can look ahead also as well. So, I already kind of more or less asked my first question here, but I'll just reiterate because we went on a nice tangent of, why microcaps are awesome and why, everybody should, follow it. But, like I said, we chatted about oil and gas back July 2023. We said at that time it was off the radar. So let's start with with your quick post-mortem on 2023.
Yeah, so I'll frame this from the perspective of oil and gas small cap stocks, because I think that's sort of, like you mentioned, there is a limited universe of folks who focus on this professionally, but I think you and I would agree that many people watching this, whether it's personal individual investors who should consult an advisor, and none of this is investment advice or anything, but of interest for them potentially because of the asymmetries of information and so on, as well as frankly for a lot of professional investors and brokers and so on who with their personal money end up doing sometimes quite different things that can be much more rewarding than what they're doing with their limitations in their careers. So I think it makes sense to think about it from that perspective. And there have been very few times in my career where oil and gas small caps and energy small caps have done worse relative to energy large caps as well as the broader market than the last roughly 6 months. It's been wild and negative and just sort of remarkable in terms of, already 6 months ago, I would have said, hey, and I think I did, that, this is an out of favor area and, small caps are oversold and so on. And then they just, it just got worse. And, where it's interesting for oil and gas is that there's so much, there's so much information asymmetry. There's so much of a variance in terms of valuations too, that actually it wasn't even that bad for Bison in terms of we had some stuff that actually did really well and we were able to get dividends or sell things that were up or whatever and then redeploy into stuff that's just hated. And we've been deploying capital into other small caps and microcaps recently in oil and gas that are truly hated at huge discounts. I was on the phone with the CEO of one of these companies earlier. I figured I might talk about it. And I was like, hey, what's going on with your stock? And he said, I don't know. Here's a couple of things that aren't great that, everyone's known, but they've known these for 6 months or so. And, why is our stock down 35, 40%? I don't know. But here's how great our things are going. And here's, I think the stock is worth a lot more. Here's why. And there's just a nonsensical dislocation. It's not logical. It's not rational. It's just, this thing is trading at, I think his estimate for his stock was that it was at about almost a 50% discount to the proved reserve value. That was likely, they haven't done their annual update or whatever. So there wasn't non-public information because it was his guess. And, that sort of jived with my guess. But, these things, oil companies should trade at a premium to their proved developed reserve value and at a discount maybe to their proved improbable and possible value. That's sort of the right bracket from a value perspective and where they've mostly traded over time. And, for something to trade at 50% of the proved producing value, it's sort of wild. It's way below where the floor is supposed to be. So it's been really interesting to see the variance in returns across these different stocks has been sort of interesting to see as well. And then I guess the one other thing to point out from an equity perspective is that the large caps have actually done really well. And the large caps doing well is important because one, they actually got to valuations that would be a huge home run for some of the small caps. If they got from 1.5 or 2 times cash flow to 7 or 8 or whatever times cash flow, that would be pretty remarkable. And then when we went out and said, hey, I think these stocks should trade at a higher valuation a year ago, 2 years ago, when they were closer, the argument was, well, the large caps aren't there and oil and gas stocks shouldn't get this because oil's going away, or here are the negatives for the sector or the industry or whatever. Well, now there are a bunch of these stocks that are trading at that level. They're just the larger, more liquid stocks, which ironically maybe should trade at a discount, and the small caps that can grow faster, that can do more creative deals, that are more nimble, arguably should trade and historically have traded in up cycles at higher valuations. So anyway, that's sort of what's been going on from a sector equity perspective. And it's just one of those things. I know in general, small caps and micro caps are, people view them as out of favor. And, there's been just such a push towards indexing and S&P 500 and the Mag 7 and whatever. And when something is just totally out of favor and everyone's on one side of the boat, it's just super exciting to go to that other side. And it feels like, it feels painful and awkward and lonely, but also, having been through this enough times and over enough years, and Bison through multiple different like down cycles and mini down cycles in oil. This is where money is made, is going and buying when things are just absolutely hated and left for dead. And, valuations are so skewed out of favor for the stuff that we're buying.
Absolutely. Thank you for that full overview there. So let's get into some of maybe the forces that are also in your opinion, are driving some of this just out of favorness for oil and gas. In your opinion, what for the last 6 months, what have been some of those forces that you think have been causing that?
Yeah, I'm experiencing the downsides of leaving windows uncovered for interviews. It's pretty exciting, but I feel like I'm gonna just keep this for now and see how this goes. I feel like I'm like a little bit of a spotlight effect, but I'll take it.
It's on you, man. You're the O&G guy. Let's go.
Yeah. So okay. So there's some stuff I got wrong last year. I didn't think that shale was going to grow as much as it did, and I didn't think that Iranian oil exports were going to grow as much as they did. And I thought that Chinese oil demand would have grown a little more than it did. And so the combination of a little less demand than I expected and a lot more supply than I expected hurt the oil market. But interestingly, it only sort of got it to a similar or slightly lower level to where it was 6 months ago. So even with a significant imbalance on both sides of the equation in the wrong direction, you couldn't really get oil below, I think, what did it get to 68 or 69 sort of recently. It was really, really hard for it to get knocked down too much. Even with all these theses around, shale is going to grow uncontrollably, which was wrong and is wrong, and Iran's going to keep exporting even more. Their exports have already been falling, along with shale production starting to fall right now from too few rigs. And Chinese demand is staying pretty steady despite the Chinese stock market imploding, which seems to be driving some stimulus right now, or at least potential stimulus in China. So it's sort of like some of the worst stuff that you would have thought would have happened besides a major recession in the US or the Western world. And oil prices actually stayed pretty firm, and the large cap stocks actually did pretty well. It's just sort of this small cap area that really seemed to trade down in line with the negative sort of news flow and the negative sentiment.
For sure. And that actually makes a lot of sense. Look, that happened. Just in general, you follow this as well, not just, sector, but from, the small microcaps have been just getting absolutely killed for the last 2 years. Right. So it kind of falls in line that like, all right, if there's sector weakness, let me get rid of these more spec names and just go on the ones that, tried and true. I don't have to worry about it because I still, want to have exposure to O&G. I just, let me just get rid of these now. And, maybe I'll come back in once maybe the cycle turns a little bit more in their favor.
That's the crazy thing is that you end up creating this really phenomenal asymmetry where the larger caps that everyone's sort of hiding in become really uninteresting from a potential or likely forward return perspective. And again, all of this, no one really knows the future, but you can sort of see these sorts of valuations and see how these sorts of cycles have played out. And then you can look on the small cap side where the valuations are ultra low and extremely undemanding. And you can see how in the past, when there have been these sorts of disconnects, The asymmetry is extreme, where you can end up doing actually really well in the small caps, and the large caps can actually go down or sort of stay flattish in an oil price recovery. And it's interesting to do this interview right now. In the last week or so, oil prices have been grinding up over the last, like every day over the last week, just as some of the negative sentiment and some of the negative narratives are starting to unwind a little. There's some data that Iranian exports are falling. There's some data showing that US shale is actually coming down a little from its recent highs. And that both of those trends might continue. And so, it's sort of interesting to the extent that that continues. If you think about what the valuations are on the small caps here, it could get really fun and really interesting really fast.
100%. Yeah, you were mentioning on your Twitter feed, you were looking at the oil inventory declines and stuff like that. Can you touch on that a little bit?
Yeah, sure. So I'm a little hesitant to focus on them too much. I think one of the things I learned in the last couple of years is that many of the data providers, they're not 100% that the data, and they put it in their disclaimers, right? It's not 100% reliable, and when there are changes, sometimes they sort of don't catch them. So I'm much more hesitant to rely on those sorts of measures, and you can probably notice in terms of the way I talk about it, I'm a lot more cautious. But yep. With that being said, you can be cautious and also aware of what the data is showing. And the data is showing that global oil inventories are falling actually quite rapidly. And that some of the places that people were saying there were large inventories, it's actually not true. They're quite small. And then both oil on water offshore Iran as well as onshore China are two places that were sort of cited as like potential problems from an oil inventory perspective. And both of them, I mean, China inventories are down a lot, particularly for, I think it was Sinopec, that had like very large inventories, a big portion of the overall China onshore inventories, and their inventories were down a lot. And that matters. It matters that it's them, because if it's Sinopec's inventory is down, China is more likely to restock them. And so that means that there's going to be, and we're already starting to see some physical market demand that's coming in to sort of prop up the market, and that should translate to the financial markets as well.
So, I want to also ask from a historical perspective, because like you said, you've seen a few of these cycles go, happen over the years. So, I mean, with everything that we're experiencing right now, what is this most similar to in your experience in oil and gas?
So it's most similar to times that I wasn't doing this professionally, which it sort of feels like a cop-out because I didn't live through it. But, I read a lot, not just sort of general finance and whatever, but also reports from oil companies and news reports from prior periods, and looking at data from prior periods. And it really does look like the data, the data now, it looks sort of similar, I'd say maybe to like the early 2000s, or sort of similar to like 1975 or so for the oil market in particular. And again, like it's not exactly the same, but just sort of the general setup in terms of the available supply coming from certain places and it being disappointing or harder to get than people are thinking, along with the consensus demand coming in higher than people were expecting. And then, the early 2000s, it really resonates for me because there's been sort of this resurgence of the .com era narrative of like technology winning and software eating everything. And, this sort of stuff where like technology is really important, and there are these great trends in improved productivity and other sorts of enhancements from technology, but there's also a cyclicality to technology. And when people get too excited about it and start to believe that it does everything, that's generally a good sign that you want to go buy some physical stuff. And oil is really good because not only is it physical, it's also necessary to provide other physical stuff. And so you can sort of get this double win like you saw in the early 2000s and in the 70s.
For sure. Another topic I wanted to ask you about, and I can't believe I haven't asked you about this before, but how closely do you look at like energy services, energy tech companies, because it seems like, especially in downturns, you would hope that some of these producers would adopt some of these new, I guess you'd say, new systems or new tech in order to make sure that they can run the business, efficiently during maybe these down markets. So have you looked at that sector at all? Do you look at any companies in that space?
Yeah. So a good friend was a co-founder of a energy analytics company that's basically won their portion of the market. And I should have been an investor in that. I don't really do private venture type stuff, but that's been, I mean, it was just extraordinary from the friends and family round, I think at a 5 million value or something to their latest in the multi-hundreds of millions of dollar value. So whoops. But
Dang.
I do follow it, and that was a wake up call. Hey, I should pay more attention to this. I have been buying stocks in oil services companies at large discounts to the replacement cost of their assets. I sort of like that. It's more of a sort of old tech sort of perspective rather than, or almost like a real estate type strategy, like buying at a huge discount for replacement cost and then sort of letting the cycle help you. But some of the producers that I'm invested in are either directly or indirectly applying technology differently. And I wrote about this last year, and it was amazing how much people hated it. And it was one of these Emperor Palpatine style, I want to channel the hate, come on, come with more of this. But one of the companies that I'm invested in that I've talked about a number of times before, and people should do their own diligence on it and so on, is Vital Energy. And Vital is hated for a lot of reasons. Some of them are fair, but some of them are very unfair. And they're excellent operators. They had a couple of problems with wells in late 2022, and it took a little while for them to grow through those problems. But their operating costs have fallen a lot in the fields that they've acquired. And one of the ways they've done it is through the implementation of AI on their essentially their operating processes and their software systems. And so people are like, oh, hey, this isn't an AI company. And it's like, well, what is AI supposed to do? It's supposed to make you more efficient. It's supposed to make you more productive. It's supposed to save you money. It's supposed to save you time. It's supposed to get you more upside and less downside. And it was accomplishing that. They were producing more, and it was costing them less. And people just mocked it. And sure, they weren't the brilliant software engineers creating the AI that they were implementing. They were just very cleverly taking AI that was available and software that was available and applying it effectively and applying it better, frankly, than a lot of their peers. So yeah, follow it very closely. And in sort of different ways, whether it's through investing in some of the services companies where technology is a big component, or some of the producers where, again, it's sort of people are like, oh, this thing is so far from an AI company. It's like, well, yeah, sure, it's definitely not a semiconductor company, but it is a company where they actually measure their improvement from these particular things. And they showed a multiple % increase in revenue and a multiple % decrease in costs, which is amazing, right? How many other places have you seen actual tangible financial impacts from AI other than just ordering software or ordering microchips? So anyway, yes, very, very much so. But also people's resistance and hatred of this was sort of exciting too. Of course, small cap companies can't possibly effectively implement technology if they're not technology companies. So
yeah, I mean, well, also, I bet there is that fear of oh no, here we go. It's going to be like what it was with cannabis, and they were an oil and gas company, and now they're ABCD AI company or whatever the heck. That's it's a fun thing that happens.
But they weren't, right? They weren't saying
they weren't. Yeah,
company. They were just saying, "Hey, we implement this, and look at how well we've done with it, and it's great." And and it's just so strange that you think. And it's actually, I think it's very promising. And again, I'm some of that I was saying sort of sarcastically, there's a huge benefit when people hate things so much that when they apply the newest thing and they actually show a real tangible accounting and financial benefit, people dismiss it and say, oh, it's not the thing. And the history of it is that first you have the software providers and the hardware providers implement these things, but then the users end up with way more benefit. And that's where sort of that Mag 7 trade last year was going, where people were like, hey, these companies actually are going to win much more from using AI. And you still had like the NVIDIAs of the world trading very well and, seeing a lot of market, credit essentially for being the hardware provider essentially for AI. But in the end, these things are there's a purpose for them. And I just, it's so interesting to see companies actually sort of being an early adopter and a winner using it, and then that being hated. I mean, that was really, it was great as a sentiment check. And then it's also, I mean, hey, it feels really good to invest in a company where, you give them very little credit or no credit essentially for this, and you get higher revenue and lower costs. I mean, I hope they do more of that, and other companies do it too.
100%. So another topic I wanted to get to on oil and gas energy is, and it goes along the lines with oil inventory declines. And like you said, some of that data, it's cautionary tale in terms of trusting where the data is also coming from. But assuming that it's the case, wanted to get your perspective on new drilling and exploration, and if you're starting to see more of that happen now, or is it more, or just curious, let's go from there.
Yeah, so there's been there's sort of the micro stuff, and then there's sort of the macro zoom out, like why is oil and gas interesting? Why does it make sense to own oil and gas equities on a multi-year time frame basis? And the single most compelling thing to me is that there's been way less oil discovered than has been used for the last decade. So we're not replacing global reserves via exploration. And we're starting to see a little more exploration activity now, and hopefully that will lead to more discoveries. But we're still in the, I think that was another, Arjun put out stuff on this, and other, investment banks and so on put out research on it too. We're still in the roughly 10% or so discovery versus production. And you really should be discovering more than you're producing, because demand has been rising every year, and it seems likely to continue on that trend for some time. And so, you're seeing a little more activity. You're not seeing that much more discoveries yet. And there's also some confusion, some popular confusion, I guess, where you'll see announcements of discoveries or in Guyana, for example, but not really discoveries. It's really just sort of a field extension or whatever in an area that was discovered 20 years ago, and then more delineated in 2015. And so what you need are more Guyanas. You don't need more wells in Guyana to delineate what you already sort of know you have. I mean, you need those too, but you'd want to see more of that sort of original exploration activity. And so without that, it's pretty promising, but also, you sort of want to see it because you don't want the world to actually run out of oil, which is a real risk if this sort of trend, you won't see that happen. But if the trend were just extrapolated linearly, that's what you would get.
Very good. So next topic. So I don't mean to go topic after time. I'm just, there's so much, and I'm not going to talk to you for another 6 months. So I got to make sure, I get it all in. Another thing I wanted to talk was macro. Again, we talked about some of the forces that were affecting what happened in 2023. Now let's talk about some of these macro forces that could affect 2024. We got Fed lowering interest rates, an election, 2 wars. How should folks think about energy and oil and gas when you're considering what's basically going to be now on the docket for most of the duration of 2024, everybody would expect?
Yeah, I mean, I think we're seeing the reversal of some of the negative stuff from 2023. And so it's pretty exciting, again, if you think about how negative the sentiment was, how negative some of these changes were, and oil really having trouble getting below $70 a barrel for very long or by very much in that context. So that does seem like it was sort of, it's not exactly a floor, but it sort of acted like multiple sort of mini downturns over the last 2 years. So that's exciting, because if you have things that are less negative, then maybe WTI oil goes to 80 or 90, and then if you end up with things that are actually truly positive, maybe you end up with much more upside. So there's a couple of things. I mean, there's a lot that's been said about the Red Sea issue, where the Houthis are shooting at ships, and the U.S. and other countries are now bombing Yemen to try to stop the Houthis from attacking these ships. And a lot of ships are now going around the Horn of Africa, so what it's called. And so you're already seeing more oil consumption purely just from ships going around and going faster to avoid this issue. But there's also this potential risk of supply disruption, which we're not really seeing yet. But if we see any supply disruption in a market that arguably now is undersupplied, which again is not the consensus, but based on data from multiple sources, which again are not super reliable, but when you see it from enough places and you start to see the physical market tighten and you see the market structure improve and you start hearing about people like bidding on cargoes and not getting 100% of what they're bidding on. I mean, it's pretty interesting, and validates some of these more sort of theoretical, I would argue, data sets. If you have any sort of supply disruption in a tight market, you could see prices move how you would have thought prices would move when you first saw war start in the Middle East. So I think there's asymmetry mostly to the upside. There is still risk that we end up in a bad recession. There's a lot of the economic data sort of bifurcated, where the private market's doing quite poorly, and government spending and deficit spending seems to be driving a lot of what's measured as economic growth. And there's sort of, it's one of those things where if it was a public company, if like the U.S. economy was a public company, the revenue would be rising, but the cash flow would be rising, but the debt adjusted cash flow would be falling. And so the debt adjusted GDP is actually quite unimpressive in the U.S. right now, and Europe is struggling. So if things get worse, which is possible, then there could be some material downside to oil. The flip side is that it wasn't great last year, and there was a freight recession, which seems to be unwinding, and so there could be some countervailing positives, even if there's an economic downturn in the U.S. So I think it's complicated. I think there's some asymmetry to the upside, and there's probably a fair price for oil here, which at current inventory levels maybe is a little over $80 a barrel WTI. And as inventory levels fall more, there's this theory around sort of a comparative inventory calculation, where you look at historical prices versus inventories, and you figure out, hey, at this price you've tended to, at this inventory level you've tended to this price. And so when you look at those studies, you get to the high 70s, low 80s, and the trajectory is up. So absent anything significant happening, if things just sort of continued how they are more or less, maybe you'd end up with oil in the high 80s or low 90s over the course of the year.
Very good. So, ignoring the price of oil when considering, what you want to see in, let's say, some of these smaller oil and gas names, or small cap, microcap, what would you, let's assume both sides. Let's assume the worst. How about that? Let's assume that it's just, it's a bad environment, economy sucks, all that kind of stuff. What are some of the things that you would like to see from some of the smaller cap names that would give you confidence that they'll be able to sustain maybe a continued downturn?
So, a lot of them, it's just you want to see them keep doing what they're doing, which is paying off debt, buying back stock, paying dividends, doing accretive acquisitions, and in some cases, divesting assets at large premiums relative to where they're trading. So more of that. And then for some companies, they've been paying off debt, and they're about to shift to buying back stock or paying dividends. And so to the extent that they shift towards capital return or increase their capital return, that does seem to help. And then there is a reality, which is I don't own Alpha Coal, but that stock has gone crazy through a buyback. And I think it's sort of inspiring a wave of buybacks as companies attempt to essentially squeeze their share price higher through absorbing as much of their float as possible. And again, like I'm averse to market manipulation of any sort, but it does seem if you can have your share price at 50 or 350, you're going to have a lot more happy shareholders at 350 than 50. And if it's not illegal, maybe it's not such a bad idea for some of these other companies to do that too. So I think buybacks over dividends here, especially for companies that trade at large discounts to easily verifiable valuation metrics that you want them to be accurate, and you want them to be not sort of cyclical highs. So at the top of a cycle, you'll see lower multiples, but you'll see a premium to like replacement cost or book value or so on. So if you're at a big discount to your replacement cost, you should be buying back stock as much as you can if you can afford it without risking your company. And in many cases, what companies are doing is taking their debt down to zero or near zero, and then buying back a lot of their stock. So it's pretty exciting that's happening. And then even among the companies that aren't doing that, accretive acquisitions are sort of magical, right? It's one of those things where the reason to be in the public market is to issue stock when you're able to create value for your shareholders, or to be able to buy it back when you're trading at a big discount. And I think people forget that sometimes. They focus too much on one thing or another, or they get really excited about financial metrics or whatever and sort of forget that there's this great tool, which is being in the public markets. You have these freely tradable stocks. You're able to take your stock, and if you trade at 4 times cash flow and you can find an asset at 3 times cash flow, and there's some synergies and some accretion and so on, I mean, you can actually, through achieving synergies and buying something that's accretive, you can end up sort of double dipping and, accomplishing a really nice return for your shareholders too.
Very good. All right. My final question for you here today, because I think we've covered a lot. You know me, we cover enough, and then everybody can do the deeper dive, follow you the whole bit. So my final question is that you recently, now going back to price of WTI, you recently appeared on CNBC earlier this year and said that oil is a powder keg and could hit $100 per barrel this year. It's great. Like that, the CNBC must have loved you when you said all this stuff. But why do you think there is this decent chance of this happening pretty easily?
Well, the anchor almost fell off their chair.
I watched the video. I saw she
yeah. And then if you see all of the links, I looked at their site, and they had 6 other interviews, and they were all bearish. And so I'll point out, oil was below $70 a barrel then, and it's up 10% since then in 2 weeks, with 100% of people they were talking to bearish besides me. So that was sort of, it feels good. And again, like, I'm not in it for 10%. But, it just, I think, was a good measure of sort of how bad sentiment was. And the reality is, actually, if you look at a lot of the interviews today, people are still pretty bearish. And you still, folks get on, oh, I'm not sure, whatever. And again, like, I think no one's sure, right? There's always a lot of uncertainty. And I think it's just helpful to sort of analyze what you have available and then come up with a view. And I try to take sort of longer term views. And ultimately, my view on oil and gas is there's not been enough exploration. And if there's not enough exploration and not enough delineation, prices will go much higher over time until that gets fixed. So for the reasons we talked about before, in terms of the Middle East risk and the potential supply disruption, as well as just sort of this trend up as inventories fall and as some of the negative stuff from last year sort of unwinds. There were sort of the narratives on shale growth were sort of half true. Yeah, it grew, but it couldn't keep growing at low activity levels. Iran, yeah, they exported a lot, but a lot of it was actually out of storage versus production and so on. So just as those things unwind, I think we have a good shot at higher oil prices. And then if there is some sort of disruption or there's some other sort of bigger economic positive, I think we could easily see 100. And, like we saw in 2022, like one geopolitical change, which actually didn't really affect global oil supply almost at all. People thought it would, but it didn't. One real risk to the oil supply could send oil up another $40 a barrel.
Very good. I mean, you got me inspiring writing the title for this pod already. I have
Oh, no.
unwinding the oil and gas negative sentiment. So I think that's probably really the main takeaway, right, from our conversation today, is that, like, you're more on the side of bullish, but that's not without risk. I mean, with anything, but I mean, listen, these sectors have just been, I mean, oil and gas mostly in the last 6 months, but just micro small cap in the last 2 years. You know, this is where, go where it's hated, or at least, take a deeper dive, learn more, not financial advice by any means, but, hey,
Yeah,
one quick disclosure, Josh, you mentioned NVIDIA, you're a shareholder in that.
I'm not.
Beautiful. All right. So we're there, man. Where can our audience go and find more information on you, follow you on social media, as well as Bison Interests?
Yeah, Bison's website is bisoninterests.com. We have a Twitter, which is at Bison Interests. And then I have a Twitter that I'm probably too active on, at Josh_Young_1. And, it's always fun to do these. Thank you for having me on. And I think the next one we should talk more about recent books that we read. I think people love, anyone that's listening to a finance podcast is probably also interested in hearing about the latest finance books, or in some cases, the one up on Wall Street's, and what you've learned from rereading.
Just some fresh takes. I mean, I'll say this, like, I can't believe this is my first. I read Joel Greenblatt's "You Can Be a Stock Market Genius" for the first time finally, this year, and it's a trip, reading it, a book that was published in '97, in reading it in 2024, and just the things that still 100% apply, and then like, my favorite part, I was joking with somebody this morning of, like, he says where to go find information. The Wall Street Journal is the best, and Value Line. I'm like, all right, 97, that's where you went, 97. But, I totally agree. I think that would be a lot of fun to do kind of a little book review type stuff,
Yeah, and on that note, I'll point you to, if you like that, you'll love The Little Book That Beats the Market.
Oh yeah, of course.
It's Joel Greenblatt's like 80-page like mini book that in
Such
very
a great
simple
writer,
language
man. Oh.
explains how most people lose money or do poorly in the stock market, and how you can just by being a contrarian value investor quantitatively, even if you don't want to spend a lot of time, you can still do a lot better in investing than if you just go with passive flows, which are sort of overwhelming the market right now. And the more people do it, the less likely it is to do well.
Oh, for sure. He's such a good writer, man. I'll read whatever he puts out there for sure. But dude, this is awesome. Look forward to our next chat, man. Good luck, stay safe, and I'll talk to you soon.
Sounds good. Thanks.
Later. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.